joining entity is able to bring its losses to the consolidated group, but must pass modified versions of the continuity of ownership test or the business continuity test. Alpha Limited is a head company of an existing consolidated group. On the 1st of July, it purchases 100% of the shares in Focus Limited and immediately consolidates. The existing group prior to Focus joining has a market value of $400 million, and the market value of Focus Limited is $100 million. In this case, Focus Limited passes the business continuity test and transfers its existing net capital losses of $1 million and a tax loss of $10 million to Alpha Limited. The transferred losses will be categorised by the type of loss. Alpha, as the head company, is now treated as having made the transferred losses at joining time and must apply any existing group losses before the transferred losses of the same type. The transferred losses of each joining entity are bundled and assigned an available fraction. The available fraction for each loss bundle regulates the rate at which the head company can recoup those losses, by reflecting the rate at which losses would have been recouped by the joining entity had they not entered the group. So, Alpha's available fraction for Focus's loss bundle is the proportion by market value of the joining entity compared to the group. This means that it is calculated by dividing the $100 million market value of Focus by the now $500 million market value of the group, which is 0.2. To recoup losses, group losses are applied first, then transferred losses may be recouped. Then, group income or gains of each type are multiplied by the available fraction to determine the maximum group amount that may be used in recouping bundled losses. We need to stop and note at this point that we are not multiplying the losses by the available fraction. We multiply the group taxable income by the available fraction. So in this example, if the group capital gain after applying its own capital losses is $10 million, then the maximum amount of Focus's capital loss that the group can recoup is $10 million multiplied by the available fraction of 0.2, which is $2 million. Focus only has $1 million of capital losses available, and therefore the entire $1 million is used and applied to reduce the group's net capital gain to $9 million. Alpha's group has assessable income of $20 million, allowable deductions of $4 million, and a group carry-forward tax loss of $5 million. We now work out group taxable income by taking assessable income, subtracting allowable deductions and the group tax loss. This leaves us with $11 million. Therefore, the maximum amount of Focus's tax loss that can be used is obtained by multiplying the group taxable income of $11 million by Focus's available fraction of 0.2, which is $2.2 million. Focus has a tax loss of $10 million available. Therefore, $2.2 million of this is applied this year, and the remaining $7.8 million is carried forward for use in future years. To recap, we must first apply the continuity of ownership test or the business continuity test to subsidiary losses at joining time. If we can utilise the loss bundle of the joining entity, then we need to determine the available fraction. Group losses must be utilised first, and then the transferred loss bundle can be recouped up to the amount of the group taxable income multiplied by the available fraction.